I think there are several challenges facing real estate capital allocators over the next 12 to 18 months and factors that exist in the equity and debt capital markets. I think the single largest is that there's so much pent-up demand for real estate. Real estate is offering for the first time one of the only alternatives for current dividend yield in a marketplace which is starved because of very low interest rates and fixed income types of securities offering very, very low yields. The byproduct of that is that real estate pricing has gotten very, very frothy in a economy which is viewed as recovering, and one of the acronyms which I use is the train leaving the station. And I think that is fueling a little bit of exuberance, a little bit of a bubble effect. These valuations seem unsustainable and very, very frothy, and because of the economic recovery that everybody expects to see, it's more likely these valuations will increase rather than decrease. So it's our view that the single biggest takeaway and challenge in the market today is discipline, is investing capital wisely, using sound underwriting fundamentals and market assumptions in order to produce rates of return that people will feel pleased with 3 to 5 years from now when the dust settles. And my sense and my counsel is that investors use sound fundamentals in the way they underwrite and don't price transactions to perfection in order to produce returns that will work for them. We have been very focused on trying to approach the European investment market in a thoughtful way, trying to make sure that we're balancing the risk and return that prevails in that market today. And in looking at those trends, Madison's investment strategy is to find core Class A real estate backed by long-term investment grade leases and cash flow streams where we can purchase interests in those prime assets from distressed sellers. And approximately a year and a half ago, we were made aware that a 50% holder of the Trianon office tower in downtown Frankfurt was looking to sell their interest because of a conviction that came down from the German regulatory authority called the BaFin, where they had to sell all of their property holdings. And when we analyzed the risk return, we felt very strongly that we were buying into an iconic 46-story downtown Frankfurt office tower directly next to the Deutsche Bank world headquarters. The major tenant in the property was Deca Bank, which lease went from the present till 2024. They accounted for 70% of the revenue stream, and that lease alone was sufficient to pay roughly a 7% current dividend yield on our acquisition cost. In addition, we paid the seller roughly 40 cents on the dollar based on their historical acquisition cost that we thought was a rather substantial discount to the current value of the property itself. And for that reason, we felt as if we bought an interest at a substantial discount, very consistent with our stated investment objective. We see several situations going on in Europe today that would allow us to replicate that same risk return that we achieved with the Trianon acquisition.